Well, Lattice was founded in 2007. We're based in San Francisco. The central ethos of our firm is to be very intentional about risk allocation and think about how to creatively manage risk, take risk in a way that can create improved outcomes for investors. We currently manage a variety of multi-asset solution strategies, and earlier this year became an ETF issuer. Largely based on our view that the market environment looking forward for asset allocators will be quite challenged. And the basis for that, a number of things we think about, but valuation certainly being a central determinant of future returns. We've come off a period over the last 3 decades where if you roll back to the early 80s, US stocks were trading at about 1/3 of their current valuation. The dividend yield on the S&P in 1982 was 6.5%. Relative to 2% now. And of course, fixed income at that point, early 80s, 10-year treasury at close to 15% relative to 2 and some basis points right now. So thinking about returns looking forward, a simple 60-40 portfolio over the last 35 years compounded at 10.5%. With these starting valuations, that's mathematically impossible. So we do think that allocators will have to be more resourceful and creative in thinking about how to source returns and improved growth, not from just the asset allocation construct, but from the building blocks they use to cover the different asset exposures. Yeah, the challenge that allocators face really is how do you source improved returns and certainly improved risk-adjusted returns. We've had a period of very compressed volatility since really 2009, and we've been reminded over the last 2 months that volatility can not only spike but also remain elevated. And given macro developments, it's very likely that volatility will persist. So in creating the building blocks that we've launched as ETFs that cover the full equity geographic opportunity set, the idea was to first seek greater diversification than would be available in a cap-weighted index and most active strategies that are benchmarked cap-weighted indices and might have similar sector concentrations, company concentrations, or country concentrations. So that's one element, be much more balanced in taking risk across whatever asset that you're covering. Emerging markets is a great example. If you're using a cap-weighted approach or an active approach that's benchmarked to cap-weighted index, which is to say all active approaches, you end up with really just a handful of countries dominating the exposure. Also very acute exposure or concentration in individual companies like a Samsung or a TSMC, which comprise upwards of 1/4 of South Korea and Taiwan's market. So thinking about greater balance and risk allocation, trying to diversify the idiosyncratic risk in some of these very large countries and companies, and then also gain broader exposure for EM to some of the smaller, earlier stage markets that are less mature, have generally better demographics, where in a cap-weighted index, as an example, the Philippines might be a 1% allocation relative to China being close to 25%. So just from a pure logic perspective, as a risk allocator, you'd have to have a very high conviction view that China is expected to generate returns so far in excess of the Philippines to have that imbalance. So that's one of the things that we've sought to address. And then secondly, this is a very common topic these days, but really trying to source and enhance just market beta by exposing on a systematic basis the portfolios to different risk factors. So things like value, momentum, quality, low volatility, size, to have enhanced exposure to those risk factors as a way of attempting to source greater return, again, than just having pure market beta. We don't have a crystal ball to think about what will happen in 2016. I predict there'll be sustained volatility. I'll make a risk prediction as opposed to a return prediction. But the comments previously about whether it's 2016, whatever time slice you take, or whether it's a longer period of time, the next 5 years, 10 years, which is a more reasonable window to have expectations. Again, we think that while the returns will be erratic and there will be periods of higher returns, there will be periods of negative returns, in general, the compounding across the traditional asset classes will be at a rate far lower than what we experienced over the last 30 years, where we had a dual bull market in fixed income and equities at the same time. So the view is, again, allocators have to think more deeply and look at building blocks they're using to cover the different asset classes and see if they can improve the outcomes from the building blocks themselves to meet the growth objectives of the end investor, whoever their client is. The conference has been a really interesting experience. There's clearly a lot of different perspectives and different issuers and different groups doing analysis of ETFs. There's been a lot of innovation. What is generally referred to as smart beta is the fastest growing area in asset management, and that's attracted a lot of new entrants. And our view is that there's a lot of credible strategies that investors should take the time to understand. At the same time, understanding at a much more clinical basis what different strategy approaches, like say equal weighting or low volatility or fundamental weighting, whatever the variant is, what are the actual exposures that are presented to the investor? And understanding factor exposures, a lot of smart beta, what I would call version 1.0, that is on the market, you may have very positive expression of, say, value as a factor, but you can also often have conflicts in some of the other risk factors that we believe offer persistent excess return looking forward, and as a result you get more erratic performance relative to cap weighted. So the advice to investors would be really understand what are the underlying exposures, the portfolio characteristics that any given strategy, smart beta